everyone, as a stock market investor, one of the most important skill set is to identify the difference between a fundamentally strong company and a fundamentally weak company. If you can do that, your 80% of the job is done. Because in many cases, fundamentally weak companies trade at attractive valuation and retail investors end up getting trapped in such companies. Although you'll always end up with a few wrong stocks in your portfolio, that is inevitable. Even the most seasoned investors end up having few wrong stocks. However, if you have a right framework in place, you can minimize that probability of having wrong companies in your portfolio. That's where in today's video, I've shared 12 such red flags that can help you filter out the fundamentally wrong companies. This is something that I've learned over a long period of time, and I'm sharing that knowledge with you all in this 15-20 minute video. Also, towards the end, I've shared two very important tips that can be a savior to help you avoid fundamentally weak companies. I'm sure this video would be very useful if you're a long-term fundamental investor. Alright, let's get started. So the first 5 flags are based on financial data. First flag is to avoid companies with high debt to equity ratio. If you look at last 20 years of data on companies that went bankrupt or destroyed shareholders' wealth significantly, almost all of them had one common problem: very high debt levels. The problem with high debt is, even if the business struggles operationally, you still have to pay high interest, and that results in losses. For example, look at Reliance Communication by Anil Dhirubhai Ambani. During 2008, it was one of the largest Indian company, and the stock price skyrocketed. However, from there, it has completely destroyed investors' wealth. One big reason was over leverage. Company had massive debt due to significant capex, and when business struggled, it still had to pay massive debt. Then look at Suzlon. It fell from 400 rupee in 2008 to 2 rupee in 2019. Again, the reason was high capex, and hence company took massive debt. But when business struggled, it still had to pay high interest, and hence ended up in losses. Likewise, there are many more examples of wealth destruction due to high debt levels. So make sure that when you shortlist any company for investment, avoid companies where debt to equity ratio is more than 1. Anything between 0.5 to 1 has to be carefully observed, and anything below 0.5 should be comfortable. Ideally, I like companies that are debt free or have negligible debt, and that's where I love asset light tech oriented business where debt level is almost zero. If you want to know companies that have negligible debt, you can simply run the query on screener, and that will give you the list of all the companies. Here, please note that debt to equity ratio does not work with banks, NBFC and financial companies, because the entire model of financial companies is to borrow money from customers and market and then further provide loans. So if you use this query on screener, remember that it will filter out all financial companies. Having said this, please note that there can be a few exceptions. For example, L&T has high debt to equity of above 1, but that's because of its capital intensive business model. It is still a leader in Indian capex and infra sector. So you might have a few exceptions as well. Then second red flag within financials is avoid companies with negative or unstable cash flow. You must have heard the phrase, in business, cash is the king. And that is absolutely true. While companies can cook up their P&L, the actual reality is visible in their cash flow statement. One great example in recent time is Mishtan Food. In 2024, company reported net profit of 346 crore. So during April 24, its share price was around 20 and its P ratio was just 7-8. Obviously, if you look at PE along with profit growth, it looked like the cheapest stock in the market, isn't it? But then share price fell down 75% to current levels of around 5. And the big reason was, while company reported massive profits, its cash from operating activity was negative. And the reason was, out of 356 crore of profit from operations, company was sitting on 371 crore of receivables. Basically, the money that company reported in their net profits was never received by them. And that was visible only via the cash flow statement. So here the KPI you need to track is CFO to EBITDA. That shows the ability of the company to convert its operating profits into cash. It should be greater than 50%. If you run this query on screener, you'll get list of some really amazing business that have created humongous wealth for the investors. Please note that it is a customized metric on screener. I've already done a detailed video on CFO to EBITDA. It's a must-watch video for every long-term investor. Then third red flag is to avoid companies with low ROE and ROCE business. ROE and ROCE are profitability metrics that suggest the return generated by the company on equity and total capital employed. As a thumb rule, avoid companies where ROE and ROCE are less than 15%. Here please note that there can be exceptions where a company has made significant investment in business or has done a major acquisition. During that phase, company may report low ROE and ROCE, but you need to track it closely. For instance, L&T has low ROE and ROCE because it is a very capex heavy business. Its debt to equity is also high, but that's because of the nature of its business. So there will be certain exceptions. Tata Power is another example of low ROE and ROCE and higher debt. To identify highly profitable companies, just put the query of ROE and ROCE greater than 20% and you will get the list of some amazing business. Again, this query will filter out banks and financial companies as ROCE is not applicable on them. You should look at ROE for banks, and anything above 15% is a good ROE for banks. For example, Bajaj Finance is an NBFC with a fantastic ROE of about 20%. No wonder it always commands a premium valuation. So as a rule, avoid companies with ROE and ROCE below 15%, with exceptions for banking and financial sector and some great companies. Then fourth red flag is avoid companies with very low operating margin. Operating margin of a company suggests the pricing power. For instance, if a company has high OPM, it means it commands a pricing power. And if a company has very low OPM, it suggests lack of pricing power. One such example I discussed long back was Rajesh Export. Company's OPM was 3%, fell down to 1% and then 0%. This clearly suggested company does not have any pricing power, and that resulted in fall in profits and eventually the share price. So try to avoid companies with low OPM. Although you will find some examples where OPM is low but the company is great, and that's because of nature of the business. One such example is Avenue Supermart. Company's margins are in single digit, yet it generates amazing cash from business and has a decent ROE and ROCE. It's because of very high inventory turnover of Avenue Supermart, and retail business have usually got low OPM business. Here, your inventory turnover is very important. Another great example is Dixon Technology. Company does OPM of just around 4%, yet it has excellent ROE, ROCE and cash conversion rate. So you need to look at business by business, but as thumb rule, avoid companies with very low OPM, with some companies at exception. Then another important thumb rule is to avoid companies with extreme volatility in OPM. Here, company might not be fundamentally weak, but the nature of their business is commoditized, and hence company does not have any command over the price. It's decided in the market. One such example is metal sector. Look at Tata Steel. In spite of being a part of prestigious Tata Group and being a leader in Indian steel sector, its OPM is extremely volatile, and hence its net profit swings to extreme end, which result in extreme volatility in share price. And the reason is steel is a commodity and its prices are not in control of Tata Steel. Hence, as a thumb rule, I always avoid investing in metal sector because I don't have the expertise to gauge the bottom and peak of metal prices. So unless you understand the business thoroughly, avoid investing in companies where OPM is highly volatile. And for that, you need to check the OPM for the last 10 years. Here you will find that many commoditized companies command a very low PE multiple, and you might get trapped if you don't understand the cycle. For example, Tata Steel share price zoomed exponentially during COVID period and peaked out around August 21. That time its PE multiple was at very low levels of 6-7. Now if you look at PE multiple, you'd think it's a great valuation, isn't it? But the reason for such low PE was in 2021, Tata Steel witnessed extraordinary growth in its net profits due to significant jump in operating margin. And then the margin fell down badly and so did the profits. So make sure that you do not simply look at PE multiple. By the way, I've recently done a video on how I check the valuation of any company in my weekly video series where I discuss multiple KPIs like PE, PEG ratio, price to sale, EV to EBITDA. And in this weekly series, I also share my own investment strategies and stocks that I buy and sell in my portfolio. But remember, this is not to give buy or sell tip, but to share my knowledge and investment strategies. I always say that if you want to create wealth in stock market, you need to invest with conviction. And that conviction only comes when you have the right knowledge. So learn the art of investing before putting your hard-earned money. Not necessarily from me. There are many great books that you can follow as well. But if you are looking for practical knowledge and how I am personally taking my investment decision, you can explore my weekly series. Also, on account of Holi, there's an additional 15% discount for next few days, but there are limited slots. For more details, you can check out my website or join button on this YouTube channel. Details I have provided in the pinned comments. Then sixth red flag is avoid companies with frequent leadership changes. If there are constant CFO or CEO exits, it suggests instability and lack of direction, a big red flag. So whenever there's an unexpected exit of the CEO, CFO or MD, it's very important to understand the reason. Then seventh red flag is avoid companies with sudden auditor exits and rating downgrades. So if companies' auditor are exiting, it's a big red flag. And if you find both leadership change and auditor exit, it's a deadly combination. One example is Brightcom Group. It was one of the most hyped stock during the COVID bull run. Stock zoomed exponentially during April 21 till December 21, and then the stock nosedived and destroyed investors' wealth. There were many red flags in the company, including resignation of CFO and MD, as well as resignation of auditors. The recent example of rating downgrade is Gensol, where CARE and ICRA, both rating agencies, have rated it to D, that is default. And the biggest reason is again high debt levels. Companies' promoters tried their hand in multiple businesses and ended up with a high level of debt. Gensol has already fallen more than 50% in last 1 month, and after the rating downgrade, its stock has tanked 47% within last few days. Then eighth red flag is avoid companies with poor capital allocation. Investing in unrelated businesses or reckless acquisition can hurt long-term growth of the company. Although this is a very difficult parameter to judge, but there have been many cases where companies ended up doing wrong acquisition or diversified into unrelated business, and that resulted in the downfall. Then ninth red flag is to avoid companies where management consistently overpromises and underdelivers. In a business, one very important factor is management guidance. Because if management gives high growth guidance, its stock price tend to go up in anticipation of higher earning growth. However, if the results are not as per the guidance, company can lose investors' confidence. In the past, I've highlighted the consistent high promises by MTR management and an extremely weak performance. Recent example of overpromise and underdelivery is SW Solar. Company's management guided for 8,000 crore of revenue, whereas now they have reduced the guidance to 6,000 to 6,500 crore. In fact, their CFO also resigned a few months ago. These are not good signs. Company was in massive losses and it looked like a turnaround story with solar adoption, but it has been a massive accident so far. Even I was hopeful of SW Solar turnaround story, but it's a lesson for me as well. Avoid low margin business, and there are very few companies that actually turn around. Here please note that sometimes management can miss the guidance due to some unexpected situation, but it should not happen consistently. Plus the margin of guidance miss should not be very high. So it should not be like management has guided for 500 crore of revenue, but they are doing only 200 crore. So that margin should not be that high. Then 10th red flag is avoid companies with frequent dilution of equity. Of late, we have heard many cases where companies have raised capital from the market either via QIP, FPO, preferential allotment. And if a company is diluting its equity, there is a high probability that it does not have enough cash to fuel its growth. Otherwise, it can grow by internal accruals, isn't it? While QIP, FPO and preferential allotment is a good way to raise capital via diluting equity and getting institutional investors or HNIs in the cap table, if the company is frequently diluting equity, it's a red flag. Then 11th red flag is rise in NPA specific to banks and NBFC. Avoid banks and NBFCs with rise in NPA, that is non-performing assets. In banking sector, you can't just look at earning growth. Yes Bank and DHFL are great example. They only focused on high growth and ignored the asset quality by giving loans to high risk borrowers, and that resulted in sharp jump in NPAs and eventual fall. Although there were corporate governance issue with Yes Bank and Diwan Housing with unethical promoters, but this asset quality is also one key factor behind how market value the company. Generally, companies that have a strong track record of maintaining a stringent loan underwriting and low NPA would always command a premium valuation versus companies that have weak loan underwriting process. Because during good time, the stock price of even the weak banks or NBFCs would go up. But the real test happens during the down cycle in the financial sector. That's where while investing in banks and NBFCs, it's very important to look at the asset quality and the history of how the bank has maintained its asset quality. Then 12th red flag is to avoid companies with high dependence on few customers. When it comes to B2B business model, it's very important to look at the concentration risk. Ideally, a company should not have high dependence on a selected few customers. Because if they lose business from specific customers, it can badly impact their earnings and profitability. One great example is MTAR. It had huge dependence on US company Bloom Energy that contributed more than 70% in its FY23 revenue. But then Bloom Energy faced challenges, so it directly impacted MTAR business. So avoid companies where there is high concentration risk on few customers. So these are some of the key red flags I wanted to share with you all. Obviously, as a retail investor, it gets very difficult to analyze so many red flags. So if you don't have enough time, here is a great tip. Avoid companies where public holding is increasing at a fast rate and promoters or FIs or DIs are consistently reducing stake. Now here, it is not necessary that company is fundamentally weak. It could also be a case where company is good, but valuations are very expensive. So this analysis of shareholding pattern gives an excellent overview of both fundamentals and valuation. You take any company from the red flag example we have covered and you will find that there is one common pattern among these companies, and that is they have seen consistent increase in public holding and your institutional investors have reduced the stake. For example, let's take Brightcom. During March 21, there were only 65,000 investors. By March 22, there were 2.67 lakh investors when share price peaked out by December 21. And when the share price kept on falling, public holding kept on increasing and number of shareholders also kept on increasing. Look at Vodafone Idea. Its share price has stand from highs of around 120 rupee in 2015 to now at 7 rupee. And its shareholding has increased from 3 lakh in 2017 to now at 60 lakh. Especially in last few quarters, public holding has increased from 11% to 24%. Then look at Yes Bank. Its share price tanked from 400 rupee in 2018 to 12 rupee by March 22. And during this phase, its public holding increased from below 10% in 2017 to 45%. From 1.8 lakh investors to 43 lakh investors. So as a rule, avoid companies where promoter plus FIs plus DIs are collectively reducing stake on a consistent basis and public holding is increasing on a consistent basis. This can really help you avoid many poor companies. Now you might ask, in case of small cap or SME companies, many times they don't have FIs or DIs holding. In that case, you need to check promoter holding. It should be on the higher side. And second, very important aspect is to look at HNI holding. If that SME or small cap stock does not have any FI or DI or HNI holding, avoid it. Because if there is a strong potential in the business, it would at least have a few HNI investors. Don't think that you are the only person who has identified a diamond in the dust. Because if there is no investment by any prominent institution or HNI investor, there is high probability that the diamond is fake. So that's tip number 1 on avoiding companies where public holding is increasing. Tip number 2 is to avoid overhyped companies on social media or companies where stock prices jumped exponentially in a very short time frame, or promoters are doing too much promotion on social media. And last thing I want to discuss is on share pledging. Is share pledging a red flag? Well, the answer is share pledging is not always bad, but it can be risky if done excessively or for the wrong reasons. It depends on why promoters are pledging shares and how much they have pledged. Share pledging means promoters use the shares as collateral to borrow money. This money is generally used for capex purpose. However, if the business gets into trouble and share price start falling, lenders can sell the pledged shares and that can result in a massive crash. So as long as business is fundamentally strong and promoter pledges less than 10-20%, it should not be a problem. But if the business is facing challenges and promoters are increasing their pledging, then it's a big red flag. Okay, let me not stress this video further. I hope you'll find this useful. And did I miss any key points on red flags? Let me know in the comments. For additional discount on weekly series, check out the link in the pinned comment. I'll see you next video. Till then, take care.